Welcome all, Abhilash here. This is first session on Unit 5, Leverage Decision and Capital Structure Decision. So let's understand capital structure with the firm value. Capital structure refers to the pattern of funding a company's long-term funding requirements. It represents the proportionate relationship between debt and equity. Debt includes debentures, term loans, preference shares, and leasing. Equity includes paid up equity capital, shares premium, reserves, and surplus. The debt-equity mix has a bearing on the small of the capital structure of the company, which affects the shareholders' earning and risk, which in turn will affect the cost of capital and the market value of the firm. Capital structure can affect the value of company by affecting either its expected earning or the cost of the capital or both. It can affect the both. Financing mix cannot affect the total operating earning of a firm as they are determined by the investment decisions. It can affect the shares of earning belonging to the equity shareholders. The capital structure decision can influence the value of the firm through the earning available to the shareholders. It can affect the value of the firm through the cost of capital. Some fundamental differences in debt and equity. Debt is a fixed claim, high priority on payments, tax deductible, fixed maturity, and no management control. As compared with the equity, equity is a residual claim, lowest priority, not tax deductible, perpetual or infinite life, and management control. So in debt there is a fixed claim. As compared with the equity, there is a residual claim. In debt, the payment is made on the high priority. In equity, the lower priority. In debt, there is a tax deductible in at every payment. In equity, there is not tax deductible. In equity, there is a management control on the equity. In debt, there is no management control at all. Optimum capital structure. So, in this session, we are going to talk on the capital structure decision. So, before that, let's understand the capital structure and leveraging. A firm should select such financing mix which maximizes its value, shareholders' wealth long term. Theoretically, it is the capital structure at which the weighted average cost of capital is minimum, thereby maximizing value of the firm. So determination of optimum capital structure is difficult because a number of factors influence its decisions. So there is no definite model that can suggest ideal capital structures for all business undertakings because of the varying circumstances. Different industries follow different capital structures, and within an industry, different companies follow different capital structures. It is more of an appropriate capital structure than the theoretical optimal capital structures. Features of an appropriate capital structures. A sound capital structure should have the following features: profitability, use of leverage to obtain best advantage for equity shareholders, solvency, ensure minimum financial risk, use of exclusive debt independent for future profitability, threatens the solvency of the firm. Flexibility to meet changing requirements when needed as with the time. Conservatism, the future cash flows should be able to service the debt as per the schedule. Control, minimum risks of loss of control of the company, and the relative importance of each may differ for the each firm. So these are the features of appropriate capital structures. Factors determining capital structure: financial risk, the risk of cash insolvency because of uncertainty in future cash flows, risk of variation in expected earnings to shareholders. Earning to shareholders will increase if the return on the investment is higher than the cost of debt and vice versa. So cost of capital. We all know what is the cost of capital. The cost of source is the minimum return expected by its suppliers, which depends on the degree of the risk. That is the risk return. Theoretically, the optimal debt equity mix for the company is at a point where the overall cost of capital is minimum. So cost of debt, the cost of retained earnings, then cost of new issue of equity shares, then cost of preference shares, and the cost of debt. So these two are the factors of capital structure. We have cash flow, control, flexibility, the cash flow ability to service debt. This is one of the main factor. The servicing of debts does not merely depend on the sufficient profits, but the availability of cash. It is necessary to estimate cash flows before deciding on preparation of debt. The analysis brings together the business and financial risks of the company by making decision on the cash flow ability. It allows to address the likelihood of insolvency and the cost therein. Control, balancing between the dilution of control because of more equity and financial risks arising out of variation is expected to feature earning in use of the debt. Flexibility, ability to change the composition in future. Promoters often use unsecured debt to achieve flexibility. Size of the company, often smaller companies have to depend on owners fund because of the reluctance of lender is providing long-term debt. Taxes, the degree up to which a company is subject to taxation is very important. Much of the advantage of debt is a tax related. If the company pays little or non-tax, debt is far less attractive than it is for the company subject to the full corporate tax rate. Firm stages in the life cycle, how firm starts. So startups, owners equity and bank debt. So in the startups, owners have a full equity shares, is having full share, is holding 100% shares, and bank debts. Bank debts means what? The starting the operation of the company, they are borrowing the funds from the bank, right? So that is the bank debt. Expansion investment needs will be high. Will generally look for private equity or venture capital or issue of IPO. So for the expanding the company, the owner of the company, he needs a fund. He need a high funds, right? So for getting the funds, what he will do? He will look for the private equity or a venture capital, where the some company will invest some amount in his company and he will take some percentage, right? Or else what he will do? He will listed his shares in the stock market like a IPO, initial public offer. From there, he will get the investment amount and he will expand his operation at various locations. High growth firms will look for a more equity issues if using debt convertible debts is most likely to be used. So this will help to grow the company at the high level. Mature growth, the earnings and cash flows will continue to increase reflecting the past investment. Need for investment in new projects will decline, right? The earnings and cash flows will continue to increase in reflecting the past investment. So in the past investment, they need the more fund, right? So need for investment in new project will decline, and the funding needs will be covered by internal accruals, debt, and bonds. So that is a mature growth. Decline, existing investment will continue to yield cash flows but at the lower phase. Firms are likely to make fresh funding and are likely to retire existing debt, buy back stocks. Others, market conditions, period of finance and industry. Typically, this is the income statement. On the broader line, we can see the total revenue on the top the line, right? From revenue less variable cost, then we have to add contribution, then again less fixed cost, right? Then you will get the total income. From there you have to less earning, you have to less interest on the debt. Once you deduct the debt, you will get the profit before tax, right? Then again you have to do, you have to less the corporate tax from the PBT, profit before tax. Then you will get the profit after tax, and then less preference dividend, then you will get the equity earning, right? So this statement, about this statement we have learned, and we have done some analysis in the unit 2. Still, if you are confused, you can do one thing, just go back and watch unit 2 webinar, unit 2 sessions. You will get all things there. Again, this is one more type of typical income statement. You can see here, this is how statements are there in the company. You can see here the debt capital, the equity. We have four statements here: 0%, 10%, 20%, 40%. Right? Equity amount is there, and debt is there. Total capital, EBT, earning before interest and tax. Then here you can see less the tax from this amount. Then PBT, profit before tax, you will get in this line, in this row. Then again tax has to be debited from this amount. Then you will get the profit after tax. This is a PBT, profit before tax. This is PAT, profit after tax. And then you will get the percentage. So whatever figure you will get, you have to divide this figure by 100. Then you will get the amount in percentage. This is the return on equity, return on investment, ROE or ROI you can say. So this answer comes in the percentage. Debt equity ratios of some top companies like automobile, Suzuki, Maruti Suzuki, 0.106, Bajaj Auto, Mahindra, Tata Motors, Bharti Airtel, Reliance Communication. Now Reliance Communication does not exist. Okay, it's not a part of the industry now. So diversified ITC, L&T, telecom. Like we have industry type companies here with the debt equity ratio. Pharmaceutical, Cipla, Dr. Reddy, Vanbex is there. Risks and leverage. Now we are coming to the main part of this session. The risks. What is the risks? Risks attached to the firm can be divided into two categories: business risk and financial risk. So we have two risks. And let me tell you one thing here. We have discussed this point before as well. So business risk. What is the business risk? Arises because of the variability of EBIT, earning before interest and tax. It results from internal and external environments, business cycles, technology in which the firms operates. It is measured by calculating operating leverage. Its degree does not differ with the use of different forms of financing. If there is any variability of EBIT in the current financial year, the company will face a business risk. Financial risk arises because of the variability of EAT, earning after tax. It results from use of financial leverage, source of funds behaving fixed return like debt. It is associated with the capital structure decision, and the degree varies with use of different forms of financing. So financial risk, if there is any variability in the earning after tax, so a company might face a financial risk. So these are the formula: operating, financial and combined leverage. Leverage refers to the use of funds bearing fixed financial payments like debt in the capital structure. Operating leverage affects a firm's operating profit, EBIT, while the financial leverage affects the profit after tax, that is earning after tax or profit after tax or earning per share, EPS. So operating leverage affects the firm's operating profit, but financial leverage affects the profit after tax. Okay, keep this important line in your mind. So degree of operating leverage is defined as the percentage change in the EBIT related to the given percentage change in the sales. It exists because of the fixed costs. Example, so degree of operating leverage of 1.5 means for a 1% increase in sales will result in 1.5 increase in EBIT. So this is the formula for calculating the degree of operating leverage. The percentage change in the EBIT divided by percentage change in sales. Here percentage change is given, percentage change increase in sales is given, right? And EBIT is also given there. Right? EBIT is also there, 1.55 increase. Or we have one more formula, that is EBIT divided by EBIT and sales divided by sales. Financial leverage is a measure of financial risk. Degree of financial leverage. So in the last slide we have learned degree of operating leverage. As I told you, operating leverage affects a firm operating profit, and the financial leverage affects the profit after tax which company is getting after the sales. right? So degree of financial leverage is defined as the percentage change in the EPS due to the given percentage change in EBIT. The formula for calculating degree of financial leverage is equal to percentage change in EPS divided by percentage change in EBIT, or EPS divided by EPS only divided by EBIT divided by EBIT. If preferential dividend exists, then EBIT divided by EBT minus preference plus dividend plus 1 minus T. T is time period. So combined leverage, operating and financial leverage together cause wide fluctuation in EPS for a given change in sales. If a firm employs a high level of operating and financial leverage, a small change in level of sales will have a dramatic effect on EPS. So degree of combined leverage is equal to change in EBIT divided by percentage change in sales multiplied by percentage change in EPS divided by percentage change in EBIT. So basically the formula will come as a percentage change in EPS divided by percentage change in a sales. In the other word, the contribution divided by profit before tax PBT. So capital structure decision process. Capital budgeting decision, replacement, modernization, expansion, diversification. So this is how companies taking the decision. If they want to replace their equipment, they can take the decision. Capital budgeting decision, this comes under in the capital budgeting decision. They want modern machines, modern equipments for the company. They want to expand their operations at various location, or they want to diversification their company. That time they this thing comes under the capital budgeting decision. Funding decision, internal sources, debt and external equity. Internal sources means for existing operation, for existing company, for existing what can say, let's say operation only. So for existing investment or operation, they need a fund, they need more fund. That time they will do the they will do more funding for internal sources. Debt, if company is having any debt they want to repay, they will take a funding decision. They can opt for IPO and they will get the funding from outside, and they can pay the debt. External liquidity, for external liquidity also they will opt for the same decision. Capital structure decision, the existing capital structure, payout policies, then they design dividend policies there that we are going to learn in the session 3. A desired debt equity mix, like effect on return, risks, cost of capital, value of the firm. So majorly we have a 4 important theories for capital structure decision. Right, capital structure, these theories explain the theoretical relation between the capital structure or cost of capital, that is the KO, and the valuation. The 4 important theories of the capital structure: first is net income approach, the net operating income approach, traditional approach, and Modigliani-Mirrell approach. So I'm sharing PDF with these 4 important theories with the example. Just go through it, and still if you didn't understand, then just come up with your doubt. We can have a one live session on these 4 theories, okay? Or else I will record one more video, one more session on these 4 theories. So some formulas: KD. So KD is the cost of the debt. Okay, so KD, for calculating K, I divided by MV. So where KD is the cost of capital, I is the annual interest rate, and MV is the market value of debt. K is equal to E divided by MV, where K is the cost of equity, is equity earnings, and MV is market value of equity. KO is EB divided by V, where V is the market value of firm and the weighted average of cost of capital. Alternatively, KO is equal to KD. There is a very big formula you can read here. So as I told you, the KO is the overall cost of capital, KD is the cost of debt, K is the cost of equity. Okay. So now I will share the PDF for these 4 theories. Just go through it, And if you get any question, just come up with the question. We'll have a session. Thank you. Best wishes.